In just the first 3 months of 2026, Dubai's commercial market did nearly 38 billion dirhams in deals. Offices are now selling over a 2000 dirhams per square foot, which is up around 166% from where they sat in 2020. That is the opportunity. But here is the risk, and I need you to actually hear this. I am Harsh and I run a real estate business right here in Dubai. And on everyday basis, I help people like you to make the right decisions based on data, facts, and actual needs. If you walk into a commercial property in 2026, the way most people do, chasing a glossy brochure and a number an agent promised you, you will pay peak prices for an average asset. And commercial real estate does not forgive that mistake the way a home does. Commercial property is something you have to understand. It's tenant demand, cash flow, business activity, vacancy risk, infrastructure, and numbers that most people never even look at. So in this video, I'm going to walk you through exactly what is actually happening in this market in 2026. The green and red flags to spot a trap. And we'll stress test a project that sold out in one day. Raw district, so that you can see how a serious investor thinks. So let's get into it. First, let's establish the lay of the land, because the headline that everyone is running with right now is simply wrong. People are reading the charts and saying market is slowing down, but it's not. Instead, it is getting smarter. The end of 2025 was an absolute record, selling 45 billion dirhams in commercial sales in one single quarter. Then Q1 of 2026 came in lower, around 38 billion dirhams. And the moment that happened, everyone started screaming crash. But look one step deeper. Compared to the exact same quarter last year, commercial value was actually up about 30%, and the total units sold were up too. And the only reason the volume looked lower is that late 2025 had a handful of giant institutional mega deals that heavily inflated the number. The absolute truth isn't that the market is shrinking, it is that the market is growing. But investors got highly selective. And just for some quick honesty, part of that March softness was the regional tension. When the strikes hit, buyers naturally paused and deals slowed down. That was the market holding its breath, and it is already exhaling. So where is the real money being spent? If we break down the market, it comes down to three distinct pillars. The first pillar is offices, which is the undeniable engine of the market. Office sales nearly tripled in value in a single year, jumping to over 8.2 billion dirhams, with total transactions spiking about 74.5%. For the very first time since 2010, more offices sold off plan than ready built. Investors are confidently betting millions on the long-term future of these business districts. The second pillar is retail. This sector repriced incredibly hard, with sales value jumping 162%. But right now, it is in a healthy consolidation phase. Smart investors are pausing to test whether the actual rents being paid justify these much higher capital prices. The third pillar is industrial, meaning warehouses and logistics. There is absolutely no drama here, just steady, dependable cash flow tied directly to trade and e-commerce. It is the quiet segment big institutions love precisely because nobody makes viral videos about it. Knowing that the overall market is strong is completely useless if you can't tell a good deal from a landmine, and for that you need to know how to filter the noise. Let's condense this into the absolute core green flags of smart money and the red flags that quietly kill returns. The three red flags that kill returns: paying peak price with zero rent math. Office prices just crossed 2000 dirhams a foot. And if you're buying in 2026 just because the prices keep going up, you are late and have no exit plan. A real investor never asks only for the price. They ask for the rent, and they calculate their net yield after every single cost. Blind off-plan bets and guaranteed returns. Buying off-plan with a weak developer with vague timelines, or trusting an ad promising you 10 to 12% of guaranteed ROI with no operator track record behind it is not investing, it is hoping, ignoring the net numbers. People calculate gross yields by dividing rent by price because it is easy, but they intentionally forget service charges and vacancy periods. But net numbers are where your actually money lives, and everything else is brochure fiction. The three green flags of smart money: real economic backing. The smart money follows fundamentals. The UAE economy grew over 5% last year, and the government deployed 1 billion dirham incentive package to keep capital flowing. Highly concentrated capital. Smart money uses location as a strict non-negotiable filter. Roughly 71.5% of all office deals happened in just 5 specific corridors: Al Sufa, Business Bay, JLT, Dubai Maritime City, and Trade Center 2. A disciplined data-driven market. While casual buyer inquiries dropped by a third, serious inquiries for retail jumped over 100% and warehouses over 70%. With prime office vacancies sitting at a microscopic 0.7%, people are buying based on strict transaction data, not on hype. Let's take all of that theory and point it at a real world project. One that literally sold out in a single day. Quick disclaimer first, because that is how I operate. I'm not telling you to buy this project. I'm using it purely as a teaching example, so you can watch how this framework applies to a real deal. Always do your own due diligence. Let's talk about the Raw District developed by Imtiaz. This is a massive project located on Sheikh Zayed Road in downtown Jebel Ali, right next to the Life Pharmacy metro station. The major headline that broke the internet that this entire project got sold out on the launch day itself. It features 4 connected buildings containing offices, co-working spaces, residential and retail. The developer calls it a vertical district, a true live, work, play environment stacked into one place. Now listen to the single most important sentence in this entire video. Phase 1 selling out is a massive demand signal, but it is not a guarantee that phase 2 or your specific unit will make you money. These are two completely different things, and the people who confuse them are the ones who get hurt in real estate. Here is a vital detail you need, because the internet is already spinning it wrong. Phase 1 sold out with studios starting around 650k dirhams. But the new phase of Raw District 2 has only just been announced. It is not officially launched yet. Anyone quoting you exact phase 2 prices right now is just guessing. So treat those numbers strictly as a placeholder, not a fact. So why might phase 2 actually be interesting if it passes our checklist? First, the corridor. Jebel Ali, Dubai South, and the Expo City make up the southwest belt where Dubai's next decade is being aggressively built, anchored by the massive Al Maktoum International Airport. Buying early in a genuine growth corridor makes time work for you. Second, the developer is highly proven. Imtiaz isn't a no-name builder. They have over 37 projects, around 10 billion dirhams in sales. They handle their own design and have a solid record of delivering on time. But let's actually stress test this property. Look at the rent math. Brokers are throwing around 12 to 15% office yields in that area. However, serious investors argue that studios might only yield 7 to 8% long-term rentals. If rents don't aggressively climb the way the brochure assumes, you have to run the real rent comparables and deduct the service charges to know the truth. Then consider the off-plan risk, and the completion is scheduled for Q1 of 2029. That is a long way out. So you must verify the escrow and the payment plan yourself before signing. Finally, analyze your exit. Jebel Ali is an emerging corridor. It will likely mature beautifully, but right now it is significantly less liquid than an established area like Business Bay or DIFC. You must decide honestly that you're holding this for steady rental income, or are you betting purely on the corridor growing? Both strategies are fine, but you have to know your goal before you buy, because that is how a serious investor thinks. Raw is just one flavor in the market. Let me quickly show you 3 other specific themes where the smart money is hunting right now, so you can run your own analysis. The first theme is prime CBD offices. This means grade A spaces in DIFC, downtown, Business Bay, and Al Sofa. Vacancy in this top tier is currently under 1% and rents are growing by double digits. Some prime segments even grew their capital value over 25% in one single year. The catch here is that you need a massive ticket size to enter, and the net yields are solid but not explosive, usually sitting around 9 to 11% net. This is the ultimate blue chip play for lower drama and strong corporate tenants. The second theme is neighborhood retail in dense communities like JVC or Motor City. These areas are packed with residents who constantly need shops and cafes. You get a smaller entry point and genuinely strong rent to price ratio if you get the right unit. But be careful, because a unit with bad visibility means your retail investments sits empty. Location inside the micro location is everything. The third theme is logistics and warehouses in DIP and Dubai South. This is the ultimate institutional favorite because it involves long leases, highly stable cash flow, and ties directly to global trade. If you want boring, dependable income and you understand the underlying spreadsheets, this is a brilliant corner of the market. To protect your capital across any of these themes, here is the exact 5-point filter I use on every commercial deal. Run any project through these questions before you spend a single dirham. Corridor growth. Is the area actually growing in terms of infrastructure, business presence, and population? Raw district bet on the southwest growth belt, while a business bay office is already proven. So know which bet you are making. The tenant story. Who actually rents this space, and do they physically exist in this market yet? Never assume the tenants will just appear. You must go and verify them. The rent to price ratio. Take your highly realistic annual rent and divide it by your total cost, including all service charges and fit outs. If a salesperson refuses to give you the numbers to calculate this, walk away immediately. Developer and delivery. Strictly verify their track record, their on-time delivery history, and ensure they have a clean RERA registered escrow account. An amazing location is worthless if the developer cannot deliver it. Before you ever buy, you must know how you plan to sell. High liquidity corridors have an active resale market, as emerging corridors may require you to hold the asset for years. So decide your exit strategy before you sign, not after. And that brings us to the bottom line. Dubai commercial real estate is an incredible wealth building tool, but only if you respect the math and completely ignore the glossy brochures. If you run every single deal through this 5-point filter, you ensure that you're securing a high performing asset rather than making a very expensive mistake. Because at the end of the day, in the market, you are either buying based on strict numbers or you are simply paying for someone else's marketing. If you find this unfiltered, data-driven approach helpful, hit that subscribe button. Now I want to hear from you. Which commercial sector or specific project do you want me to stress test next? Drop in the comments below. I read every single one, and the most requested topic will become our next video. Thanks for watching.